Imagine using the 15 minutes for your entries and using the 4-hour buy side or sell side liquidity as your take profit. So, guys, this is how I easily catch 1 is to 3, 1 is to 4 trade setups thanks to ICT 2022 entry models. It's the best entry model because it allows you to refine your entries on the lower time frame, and as a result, you end up having a tighter stop loss and a good reward. For those people who have been following me on Telegram and TikTok, they can tell you that I've been using the same entry model in all my trade setup. So ICT 2022 is an entry model that ICT introduced in its 2022 mentorship. And you need to understand that this is just an entry model and not a full trading strategy. We use this alongside analysis on the higher time frame. So on the higher time frame, you need to find your narrative or bias. Once you have your bias for the market, you're now going to use the higher time frame. PDRAs can be order blocks, fair value gap, whatever it is, and we call that point of interest or key levels. Let's say, for example, you identify a 4-hour fair value gap. So now you're going to use the 15 minutes to look for entries. And now this is where we are going to apply our 2022 entry model. So these are some of the things that we look for this model. We need to see a liquidity sweeps, and this is where price takes out key highs and lows. If you don't understand what these liquidities are, guys, I normally teach this in my bootcamp. Just check the link on my bio and you can see how you can learn all these things from me. Then you also need to look for market structure shift. So market structure shift, this is just a break of internal structure that confirms the directional intent of the market. Then we look for entry using any PDRAs. So we're also going to use this model to set our stop loss and take profit. So this here is an example of a market. This higher time frame point of interest is your higher time frame key level, whatever it is. In this case, it means you've already done your analysis on the higher time frame, and your narrative is bearish. So this higher time frame point of interest is a bearish PDRA. So now, once price tags your higher time frame point of interest, and the candle that tags the point of interest closes on that higher time frame chart, we now move to the lower time frame in line with the higher time frame. If your higher time frame is the daily, your lower time frame will be 1 hour. If your higher time frame is the 4-hour, and you're using the 4-hour point of interest, your lower time frame will be the 15 minutes. So now we come to the 15 minutes, which is our lower time frame, and look for liquidity sweep. Liquidity sweep is when price sweeps any liquidities, can be previous session highs, or whatever liquidity it is. We're looking for that. Then the confirmation that we need is a market structure shift. Very, very important. And market structure shift will happen when we get a candle body close below this swing low here. At this point, if it is during your kill zone session times, we are now going to use any PDRAs on this leg that caused this market structure shift to look for entry. You can get a fair value gap, you can get an order block, you can get a breakup blocks, you can get mitigation blocks, whatever it is that you get, you use that for entry. And once you take a trade, your stop losses is always above this high that created the last high before we got the market structure shift. So this is where you're going to put your stop loss, and then your take profit, you're going to use any liquidity. For me, if I'm using the 4-hour as my higher time frame to get the point of interest, I'm going to use the 4-hour buy side or sell side liquidities as my take profit. So as a result, of course, my stop loss is less and tight because I'm using it on the 15 minutes, and I'm also getting a good reward because I'm using the 4-hour liquidities as my take profit, or any liquidities that you can see. You can even use previous day session liquidities, previous week session liquidities, whatever liquidities that make sense at that time you're observing the market. So here, this is an example where you can see price tags this 4-hour fair value gap. We get a liquidity sweep. You can see we're taking out all these lows here. These are liquidity sweeps. And then we get a market structure shift, and you get your entry here. This is also another example. This was a GBP USD trade that I took during CPI news release. This was a 4-hour fair value gap. This market was bearish, so I marked my bearish fair value gap as my higher time frame point of interest. And you can see when CPI news was released, this candle here, we got these liquidity sweeps. We took out these highs here, and of course, we had market structure shift here. This bearish candle here is the one that caused market structure shift. So after we get that market structure shift, you can see we have this candle retracing. This is a breaker block here. This is an order block here. So this candle here is the one that you would have used for entry after this CPI news candle. So this one here would have used for entry on the breaker. You can also see it tagged the order block, and here you go. You would have taken your profit and you're done with the trade. So this is how I use this entry model, and it is actually the best